G'day and welcome to Motley Fool TV for April 2025. I'm Adam Surplice, and joining me as always, our Chief Investment Officer, Scott Phillips. G'day, Scott.
Adam, g'day fools. Thank you for tuning in. Time to be alive, isn't it?
Sorry about that. I just had my own voice through me, so I got lost for a sec, but I'm back now. Okay, so firstly, our standard disclaimer. We're licensed to provide general investing advice only. We can't give personalised advice. Having said that, we will be answering questions from the live chat, so feel free to throw questions in there at any time and we'll get to them. But firstly, let's get started. The uncertainty continues. We're 3 months into the second Trump presidency. Newest administration's daily machinations continue to throw markets around, ours included, almost but not quite eclipsing the upcoming federal election that we're having in this country. But Scott, to get started, in new inflation numbers out today, run us through them.
Yeah, I like that you call this uncertainty continues. It feels like one of those Star Wars episodes. Your Star Wars, uncertainty continues. One of those kind of taglines that maybe it's Trump 2.0. I'm not sure what we're...
Well, hopefully we're in episode 2 right now, which was the best one.
Oh, there you go. I like that. Yes, let's go with that one. Yeah, here we find ourselves in a weird situation. Let's go with the inflation numbers first. The inflation has been fascinating the last couple of months. I say fascinating because I'm an economics nerd, but it's been really, really interesting. And there's something for everyone in these numbers, particularly coming up to an election, particularly coming up to the RBA decision in 3 weeks' time. Essentially, what we have right now is headline inflation, the kind of the stuff we're paying every day, right? Take out all the other stuff for now. Just how much are our prices going up? The answer is 2.4%, and that's exactly the same as it was last quarter. Now, we're talking about the March quarter numbers. They're a month old, but we get the numbers from January to March. Inflation was up 2.4%. In other words, everything was 2.4% more expensive than it was this time last year. And as I said, that was the same in the December quarter. Now, if you want to be positive about it, you say, hey, under 2.5%, that's still really good. Ongoing numbers roughly in the midpoint of the RBA's range, that's good. Would we like less, of course, because we'd all rather not pay more for everything every time. But that's where we kind of find ourselves. The underlying numbers are the ones that we've been trained by the Reserve Bank to pay more attention to. Why? Because they know that's the real measure of, without all of the stuff that's in the edges, I'll talk about that in a second, on an underlying basis, on a kind of strip out all the rubbish, what's really happening to prices. Now, good news there, went down from 3.2 to 2.9%. Now, that's good because it's under 3%. 3% is the top of the RBA's target range. So for the first time since, I think, 2021, we can say that inflation is now within the band that the RBA was looking for. And that is unquestionably good news. A couple of things. Firstly, the market was expecting a lower number. So we actually saw the ASX fall, rebounded and recovered all of those losses. But initially it was like, well, we want it better than that. That's not so good. That's the first thing. Second thing is, we know we get there because of the fact that electricity subsidies are in the headline number and petrol and fruit and veg are really volatile. So you kind of got to allow for that one. What's really, really good about this inflation read, though, is so-called services inflation is down. Now, I'm not going to get too technical at 8 o'clock on a Wednesday night on the Eastern Seaboard, but effectively, there's goods and there's services, right? Services are things that we do: hairdressing, vets, doctors, education, the stuff that is provided by humans, our one-to-one service, physiotherapists. What's really great about the services inflation number is that's coming down. Now, why is that important? Well, when inflation started to peak, and when it started to spike, I should say, why was it doing that? Well, it was largely because of goods inflation, the stuff that we imported. Remember, supply chains bogged down, oil went up, wheat went up, why? War in Ukraine, a whole lot of other stuff, COVID, of course, itself. That was what started it. And what happens then is people say, well, hey, boss, I'm paying more for my baked beans and my bread and my oil. I want a pay rise. And so that's when we get goods inflation turn into services inflation. It's no more expensive for an Australian to provide those services year on year, except that my costs go up. Why? Because my goods go up that go into providing that service. And what the RBA has always been concerned about is that inflation becomes endemic. In other words, it gets stuck domestically. And so you get imported inflation through goods, and then you get domestic inflation through services. And what's really good about these numbers is everything except for, I think, vet services, as it turns out, was going down. Now, the prices aren't falling, but the rate of inflation is reducing. And so where we did get that second echo, the kind of ripple out from the pond, goods first, then services go up, what we're now seeing is services inflation is moderating quite meaningfully. And that's really, really good news. So lastly, the RBA is going to have to try and work out what to do with this. We know they cut rates in February. By the way, two of the major banks saying that's either a done deal or locked in. That's their words, not mine. So they're saying, look, they're 1,000,000% confident, too confident by definition almost, but that we're going to have a rate cut in May. What the Reserve Bank's got to do is a couple of things. They've got to firstly work out, is 2.9 low enough, and is it going to keep falling? And no one knows for sure, but Michelle Bullock, the governor, has been really, really clear about two key words. Firstly, she said midpoint of the range, midpoint being the key word. In other words, she wants to get to 2.5%, not just 2.9 something, but she wants to get to the midpoint of the range. The second word she's used is sustainably. In other words, if it dips there, then goes back up, that's no good to anybody. So the Reserve Bank wants to make sure they believe it's going to get to the midpoint and it's going to be sustainable when it gets there. That's the two things they're looking for. The challenge is a couple of things. Firstly, no one knows the future. Secondly, you mentioned the election campaign already, and we can get back to that in a second if you want. But for now, at least, there's a lot of spending promises that have been made. There's been tax cuts promised, petrol excise cuts promised. The government's going to extend the energy subsidy for another 6 months if they're re-elected. These things all add to economic pressures and potentially spending pressures and potentially inflationary pressures. So the Reserve's got a really, really difficult job. They've been saved from having to make a rate cut decision during an election campaign, which I'm sure they're very happy about. They're completely independent, by the way. I've said this before. I don't buy for a second that they are in the pocket of either the LNP or the Labor Party. They're not. They're independent. They're doing the right thing. But they don't want to be seen to be tarred with that brush. So after the election is great. It means they'll know, firstly, they can decide without the political pressure. Secondly, they'll know the policies of the party that does form government after this election. And that gives them something. They're going to have to work out, as I said, inflation's down a bit, which is nice. Is it down enough? Is it going to keep falling far enough? Is it going to stay there once it's there? And have the promises made during the campaign made that job harder? I still think, no one knows, I don't do predictions, as you well know, Adam. Everyone asks me and I keep saying I don't know. Reasonable to assume if you're framing a market that a rate cut is favourite, maybe even odds-on favourite, but anything could happen. The Reserve's going to have to work out how they balance all those issues. Plus, by the way, speaking of politics, the tariff and trade war problem and the potential for a US recession. So plenty for them to chat about around the board table in a few weeks' time, and there's lots going on in the inflation front as well.
Yeah, and still on inflation, so assuming tariffs don't go away, the US tariffs don't go away, and again, we'll delve more into this later on, but just on inflation, is it likely that the world will basically start to redistribute the flows of goods? Are goods going to become cheaper for us in Australia? If China's paying whatever tariffs they end up paying for their exports, does that reduce the price of goods globally and make things cheaper for us and impact our inflation rate here? Yeah,
I'd hope so. Very possibly, mate. And we don't know for sure. You're right. That one outcome is particularly China has to find new markets for its products, desperate to keep economic growth alive, try to find other places to do business, and maybe Australia is one of those. That'd be lovely, absolutely lovely. The challenge we've got for anyone else dealing with not only the US, just around the world, the US remains the world's largest economy by quite a deal, but the world's largest consumer economy by miles. And so when you're looking at, if you're China and saying, where else can I sell some stuff? You go to little old Australia, we're about 1/15 of the size of the US, and say, can I sell you some more widgets, please? They probably will, and I hope desperately, to your point, that we do end up getting a better price as a result, as they desperately try and find markets. The challenge, I suppose, to some degree, is there's a parallel for us because we know what this is like. Speaking of China, they put tariffs on a whole lot of Australian products quite a few years ago now. Australian wine, barley, seafood, plenty of other 4 or 5 other categories besides. Australian winemakers, for example, had to find other markets. I'll get back to why I'm talking about winemakers in a sec. They had to find other markets for their products. Now, getting that's not easy to do that, right? And yes, you could try and discount your price to get there. That's partly what they did a little bit. But you kind of got to create the demand for those products in those markets. Just because the price is cheaper doesn't necessarily mean we're all going to want to buy stuff that we weren't buying 2 or 3 months earlier. The good news, by the way, for Australian winemakers, and why I said I was mentioning that one, is wine exports are back over $1 billion last year to China alone. China has resumed its place as Australia's largest export market. So amongst all the volatility and concern and noise and doom and gloom, some really positive for Australian winemakers. Still plenty of wine, by the way. There's always a wine glut in Australia, but that's really good news. So look, I'd love to hope that we get a lower prices out of them. I think probably on the margins we will. I'm not convinced that will be enough to offset the pain we may well receive from the ripple out again of the potential US downturn. If the US has inflation, if the US has a recession, both those things are possible as a result of this. Can we avoid it? Probably not. So yeah, we can probably buy a few things cheaper, a little bit cheaper from China as they find new markets. I suspect, I fear that may be swamped by the economic impact of the world's largest economy, the world's largest consumer economy, as I said. either going into recession or having a meaningful downturn. By the way, if there's US inflation, that probably gets passed again to the rest of the world. So still some pretty choppy waters to sail through.
Yeah, sure. Okay, so closer to home, back to the election. You touched on a few of the potential outcomes. I guess at this point, a Labor win is looking increasingly likely, but still not in the bag. Have you seen any sort of policies, promises from either side that are going to have a meaningful impact on Australian investors?
Not really, mate. This has been a bit of a damp squib election, quite honestly. Very much a small target from both parties, very much a me too from both parties. I've seen Jeff Wilson in the media regularly. The big one is potentially the Labor Party's plan to tax unrealised gains in superannuation funds over $3 million. That is a terrible. There been some awful policy over the last couple of years from both parties, quite frankly, mate. I'm really quite depressed. For those who listen to Motley for Money, I did a bit of a 3-minute or 5-minute kind of mini rant, mini plea at the end of the last Friday's episode, basically saying, please just vote carefully, vote sensibly, and frankly, maybe it's time to look at some independents or minor parties. Not because I have a particular barrier to push, just because I think the majors have been so incredibly disappointing. So yeah, look, let's be honest. So if you've got nice problem to have, right? If you've got more than $3 million in super, then you're doing okay. But taxing unrealised gains is just stupid policy. I've been very clear on a couple of these things. Tariffs are stupid policy, by the way, on the right. Taxing unrealised gains, stupid policy on the left. I'm an equal opportunity critic, but also, by the way, happy to give bouquets when I think you're doing good things. But that's just a terrible policy. Here's why, very quickly. Let's say you got $1 million house inside your super fund, and that $1 million house goes up 10%. You made $100,000 profit. Now, in the current circumstances, you carry that profit through when you eventually sell. Maybe you sell it for $1.5 or $2 million, hopefully at some point. You pay your capital gains tax on the gain when you sell it, right? You get some cash in, you pay part of that cash back to the government. None of us love necessarily paying lots of tax, but that's a fair way to levy tax. In the current environment, in the plan, the policy that the current government is proposing, if your $1 million property gained 10% next year, you'd have to pay tax on that $100,000 gain at 30%. In other words, you're going to find $30,000 to pay a tax bill. You may have got zero income because you still have the asset, right? Maybe you got some rent, hopefully, but have you got enough money from that to pay a tax on an unrealized gain just because the paper value of your, imagine shares, right? BHP shares go from $30 to $33. All of a sudden, you've got to pay tax on that, even if you don't sell them. It is absolutely a stupid policy, really, really bad policy on a dozen different areas, dozen different fronts. So I find that. So that from an investment perspective, that's probably the key one. I will hasten to add, the housing policies of both parties are abominable. Not to say it's an impact on investors per se, more the point that I'm not just picking on the Labor Party here. That super for housing, I've written about this 2 or 3 times on our emails that go to our members and our readers, mate. Super housing is a terrible idea. Rating is super. Well, I guess that's the other thing, right? If you're taxing super at a stupid level for stupid reasons, that's bad. If you're taking money out of people's super and saying, hey, blow it on a housing deposit. Now, when I say blowing it, I literally mean blowing it. People say, well, it's better than have a house than not, isn't it? Like, yeah, it is. But when I do that, I bid higher than you at auction. So you say, well, I've got to grab money out of my super hub to counter Scott's bid. All we do is ratchet up house prices and we empty out super accounts at the same time. So these are so-called affordability measures. Same with the government's, insurance deposit scheme or the first home equity scheme. They're all exactly the same thing. They're ratcheting up demand, which pushes up prices, which means no more affordable for anybody. The first person who gets in, it's affordable for them. They get to use their super before everyone else realizes they're off scot-free. Give it 6 months, and that becomes the new normal. Everyone has to do it because everyone else is doing it. It's kind of like the old US-Soviet mutually assured destruction when they both had nuclear weapons. It's kind of the same thing, except this time we're all firing our weapons at each other at the same time at the auction or at the sale. So yeah, just be really, really clear before anyone thinks I'm having got one side or the other. There has been enough atrocious policy across the board to make a brown dog weep, frankly. And that's kind of where we have to start with. Again, I'm not going to tell you how to vote. I know how to vote. I'm certainly not going to tell you which one of the major parties should preference first. But to some degree, I think sending a message to Canberra that there is a decent amount of disappointment in the electorate, and we are going to say, hey, maybe some of these independents, maybe some of these minors, I don't care whether you're left, right, or centre, is probably more useful. I won't go more political than that, but just to make that point that you'll have to preference one of the majors last, and in most electorates they'll be the ones who get your final vote. But some degree of, hey guys, how about you pull your heads out of the sand? Here's the other thing for investors, Adam. You asked about it. I'll make it really quick. My personal view, and others can disagree, my personal view is the biggest thing governments can do for investors is actually have a healthy, stable, prosperous economy. Far more than a tax break, far more than an industry incentive scheme or something else that might make money. We're long-term investors, right? If you reduce BHP's tax next year, the share price will go up a bit, and that's fine. But whether BHP prospers or not over the next 5, 10, 15, 20 years depends far more on the way the country is run, the health, the prosperity of the economy, the red tape, the infrastructure, all those kind of things. So I got to say, structural budget balance, really, really important. In other words, yes, have deficits when you want to support the economy, but please offset them with surpluses so that we balance it back out. That's kind of economics 101. Neither party's prepared to do that. Infrastructure, red tape, those kind of things we should be looking at and dealing with. I'm absolutely whistling in the wind because neither party is seriously talking about it. They're all too busy hiding under their own pretense of affordability measures or, frankly, just cash handouts. Here's a petrol excise discount. Here's an income tax cut. We're being bribed with our own money. I'm an optimist, by the way. I sound really, really cynical right now, and I wish I didn't. I'm a massive optimist. I think Australia has a bright future, despite, frankly, what some of our politicians are doing. But yeah, that's kind of the situation we find ourselves in. When I haven't decided I'm going to vote for this Saturday. I won't vote for a major first. But when I go to the ballot box, I'll be looking for which party or parties do I think give us the best chance of long-term prosperity. That's how I'll cast my personal vote. I just ask people not to vote on partisan lines. Don't just barrack for your team. Really have a look at the policies and pick a party, major, minor, independent, that really is the one you think has got the best interests of the country at heart. I'll end the political spiel there, Adam. Sorry.
Yeah, if only we had that technology to vote on policies and not personalities, right?
Right.
Anyway,
yeah.
Let's move on to some questions because we've had a pile
Awesome.
come in. First one from William about one of your favourites. Do you see traditional defensive stocks such as Surplice and Wesfarmers as an important part of any portfolio at this stage?
Yes, William, but not for the reason you think. So here's the problem. Anytime you invest, if you're going to beat the market, you have to have what we call a variant perception. In other words, you've got to see something no one else does. Why? Because if you see what everyone else sees, then the price already reflects what everyone else sees or thinks or knows. Okay, so let's take it back to your question. Is it a good time to own defensive companies? Probably if you're trying to minimize volatility. But if you're going to do that, the time to have bought them was at a time when no one else was trying to make that trade. A few weeks ago, time is merging. I want to say 2 weeks ago, there was a really big fall on the US market. Three of the top 5 stocks were Woolies, Coles, and Endeavour Group, the business behind BWS and Dan Murphy's. Why? For exactly the reasons as you suggest, William. Everyone went, I don't know, but Woolies will still sell groceries, Coles will sell groceries, and Dan Murphy's will sell grog. I'm going to buy those. Those are the shares everyone's rushing into, right? Rushing out of the risky stuff, rushing into the less risky stuff. At that point, the trade, I won't say the trade's over, but everyone's already making that trade. So at that point, if you jump in now and say, I know what I'll do, I'll jump into these companies. It's like, dude, everyone's already there. The trade's done. The price already reflects that reality. So, I'll try to do your question justice. Firstly, I think Surplice is a great business. I think Wesfarmers is a great business. I own shares in Surplice for full disclosure. We've recommended Wesfarmers before. I don't know if it's an active recommendation currently, but we have in the past recommended it. Great businesses. Depends. What are you looking for defensive? I can't give you personal advice, by the way, William. What's an investor looking for defensive qualities for? If you're trying to minimize volatility, that's okay, but you're probably paying full price for that. In other words, you pay a high price for the insurance, effectively, of reducing volatility. If you're saying, well, actually, I'm a long-term investor, and you should be, and by the way, our co-founder David Gardner spoke to our Motley Full Platinum event earlier today, and he famously says long-term investing should be a tautology. All investing should be long-term. If you're going to be an investor and you're going to be investing for 5, 10, 15 years, then the short-term volatility is going to just be noise, right? The COVID volatility is fading away. The GFC volatility is fading away. The .com volatility is fading away. It does over time. So I wouldn't buy, personally, I wouldn't buy own Surplice. I wouldn't buy it now for volatility protection because what do I want to do? I want to maximize my long-term returns. My job right now is to look at the entire ASX and say, in 10 years' time, which companies will I be glad I bought today? Now, that's not everybody's approach. If you're someone who really doesn't like volatility, if you can't stand it, if you're worried about your money, if it keeps you up at night, then you've got to do something different. And having those defensive companies because you know that they're okay, there's a lot of psychic, emotional value in that, right? And if that's you, by all means, make that decision. But for me, my job is to maximize my returns and the returns of our members over the next decade plus. So if I bought, let's say Surplice was overpriced right now. I don't think it is. It's a buy for me right now. There's a free stock pick. It is a buy, but not because I'm being defensive, because I think over the next 10 years, it'll be market beating. That's specifically why I recommend it. It's why I own it. If that's your view, great. And that's what I'm trying to pick stocks that are going to beat the market over that 10 years time. And I'm prepared to accept the volatility because that's how you have to do it. You don't get a choice of avoiding volatility without paying the price. And the price you pay is not formal insurance, but you're paying up. You're paying high prices for those companies everyone else loves as well, because everyone else wants to buy Woolies, Coles, Endeavour, Surplice, Wesfarmers to get a good price. So yes, I would buy Surplice. I don't think we have a positive recommendation on Wesfarmers, but I don't just like the business. It's not cheap right now. But if you own both of those companies, you'll do fine. I think Surplice will beat the market. I'm not sure Wesfarmers will beat the market from here, at least from the current price. But by all means, if you need defensiveness, that's one way to go. Me personally, I've made a deal with myself and frankly on behalf of our members to say we will deal with volatility. We will ride the waves. I just watched the Jessica Watson, the 16-year-old sailor, the kind of docudrama they made about her sail around the world. You got to ride the waves to get to the end, right? You can stay safe by being in port. You'll say, I'm never going to lose any money. If you want to get those outsized returns, you have to accept the volatility that goes with investing in individual stocks. I'd rather find a company that's going to be great in 10 years' time, the one that's going to be mediocre in 10 years' time, but I had less volatility. That's just my approach. Everyone's different.
All right, very good. And so your favourite tautology is back in the next one from Jake. What are your thoughts on Dominos over the next few years and also long term? I'm glad you made that distinction, Jake. What are your thoughts of closing stores that'll help that business?
I'm glad you made the distinction too, because I have no view on Dominos over the short term. And here's the great thing about being at the Motley, Phil, Adam. I work for you, and I always value the fact you let me do it. I value the fact that the company as a whole lets me do it. I get to say I don't know more than anybody else in my position, either in the economic space or in the investing space. Why? Because everyone in our space is supposed to have a strong conviction so they can convince you they know what they're doing and they promise they're right, and conviction sells and reassurance sells and all that kind of stuff, right? I don't know. They've got 12-month price. Who knows what Domino's is going to do in 12 months' time? It's silly. It's just absolutely silly. One of my favorite quotes, I've probably used it in this space before. John Kenneth Galbraith said, pundits forecast not because they know, but because they are asked. I think that's so true. 12-month price targets are stupidity, right? Just dumb. Sorry, I'm being a bit direct here, but let's go with it today. No one knows. You can't know. How are people? Imagine 12 months ago trying to predict the first 100 days of Donald Trump's presidency. I mean, really. Anyway, so I don't know the short term. Reasonable to ask the question. I'm just going to say I don't know. I don't blame you for wanting to know. I'd love to know too. I don't know. Long term, I think Domino's is a buy, and I own the shares for full disclosure. They are having, sometimes the phrase firing on all cylinders is overused in investing. Domino's has been misfiring on about half their cylinders for the last 3 or 4 years. The Australian business was in trouble. The overseas business was growing nicely during COVID. The Japanese business went nuts. You mentioned those stores. That's the ones they're closing in Japan largely. It's been one of those things where some's doing well, some's not doing so well. The thing is, the company is sales in Australia and New Zealand, I want to say we're growing about 8%. I think that's right. I haven't got the numbers in front of me, but really, really good for a relatively mature franchise business. Those numbers are great. The total revenue is growing nicely. The international business is dragging them backwards. So here's the thing. If you look at the business model of Domino's, it is really capital light. They've got fantastic brand. They've got super dominant market share in Australia and New Zealand, less so overseas. There are some challenges there. I wouldn't be surprised if they close some of those territories down entirely, by the way. I don't have any inside information. That's just my guess. Eventually you say, well, we tried. You just got to pull a pin at some point. But great Australian business, great brand, great economics. The franchisees do most of the work. They get to own the brand, get the benefit from that, invest in the systems and the processes and in some cases, the provision of supply and services. And the more stores they can open or franchises they can open, the better it is for the business. And here's why. So let's say my local Domino's, I have been occasionally known to grab a Domino's pizza or two. The local Domino's is 10 minutes away. And that's great, but it means my Domino's get here a little bit late. It's a little bit cooler when I get it. And it's fine. As sales grow in my area, I got 10 minutes to my left, 10 minutes to my right. Eventually they say, well, hang on, there's enough business in this area now. Let's open one in the middle of those two stores. Now, you've got to be careful you don't cannibalize your franchisees, but if you do it smartly, all of a sudden, my local Domino's is 3 minutes away, not 10 minutes away. So I get the pizza more quickly. It's hotter and fresher when I get it. The franchisees make more money. The system itself makes more money. And it's a really nice virtuous circle. So that's a really lovely business model to have. As I said, they're dominant in this space. One of the very few products that delivers really, really well. God love Uber Eats and DoorDash. I've used both of those before as well. I like Guzman and Gomez, for example. But a delivered GYG, I've never had a good one. It's fine. I've had it sometimes, but pizza always gets here really good, just because it's just a form factor that tends to work for delivery. So I think it's got lots of growth left. I think they'll probably work out most of the international problems in time. The share price really is far, far lower than it deserves to be because the market has lost faith with Domino's. I'm always happiest. I've said this before. I always love being the optimist in the room of pessimists, right? When I'm an optimist in the room of over optimists, of irrational exuberance, I'm always kind of like, oh, it feels a bit excited, and maybe I'll go and sit in the corner and just, not get too carried away here. When everyone else is moping around saying, oh, this is terrible, it's never going to work, it's never going to work, you look at yourself and think, well, hang on, how's Domino's not going to be a great business in 5 or 10 years' time? I think it will. No guarantees, by the way. I could be entirely wrong, but I like it very much. I think it's got lots of legs of growth left. They're doing a great job with add-ons. They're doing a great job with delivery. Doing a great job with store growth. They're doing, some really, really good stuff. New CEO will revitalize that business, I presume. So we'll have to wait and see what happens there. But yeah, I think Domino's, particularly at the current price, I think it's likely to be a market better from here.
Very good. That's good to hear, by the way. All right, two-part question from TC, and you've answered the first part. The first part is, do you consider the taxing of unrealised gains on super balances above $3 million fair? Well, skip back 15 minutes, TC, and you will find a rant of epic proportions about that. But the second part, I think, is worth considering is the land tax idea. So I think it was New South Wales was considering land tax instead of stamp duty. On the surface, that sort of seems to make more sense than stamp duty, at least. What are your thoughts on that in terms of solving the property price issues that we're having?
Oh, that's such a big topic. I'll do my level best in relatively short time.
The short version,
yeah. So I don't think it fixes the affordability problem for the reason I've just said. If all of a sudden everyone's got, let's say to put away 25 grand for stamp duty. If that goes away, you put 25 grand more towards a deposit. I do that, you do that, Adam, you do that, and 3 other our viewers do that. All of a sudden, we're all bidding more at auction. So whenever you take cash, you're effectively moving cash from stamp duty, which is, by the way, not a great tax. I get it. You move it across into the purchase price, and all of a sudden we all inflate our potential bids, and the prices go up. So from an affordability perspective, I get where you're coming from. I don't think, again, the first person to do it gets a great deal because they've got 25 grand, 40 grand more in their back pocket. They can go and do the deal and get a house they want. The price hasn't yet risen, but give it a couple of weeks, give it a month, give it 6 months, and the market just kind of finds its own level, right? Everyone's got more money to bid. What happens? More demand, same supply. Economics 101, prices go up. So I don't love it for that reason. I'm kind of a bit torn on land tax and stamp duty. Big lump up front seems unfair, seems unreasonable, seems a block to purchase. All of those things are true. Now, you take it away, people bid more, so I don't think it solves that, as I've already said. The other thing that just concerns me a little bit is you pay stamp duty up front and the money's saved and then it's spent and then it's gone and you have no obligation after that. I've used the example for my mother who's in the same house. She's been in that house for 48 years and 47 years. The stamp duty up front, they reckon the New South Wales government will show about stamp duty and land tax and about a 12-year crossover. In other words, if you stayed somewhere for less than 12 years, you're better paying land tax. If you stay there for more than 12 years, the land tax costs you more. Now, I'm not so sure we want to add more yearly tax burden to particularly pensioners and self-funded retirees at a point in time where adding more to their ongoing recurring costs is probably not great for their standard of living. So I feel a little bit torn on that one. It's more reliable as an income stream for government. I get why governments want to do it. I get why it looks attractive because it feels more affordable. I don't love stamp duty in general, as I said. So I'm not even sure I wouldn't make the change. Maybe it's still the lesser of two evils. But I would caution people to believe it's an affordability answer when that money is going to go somewhere else anyway. You end up just with more people bidding more money for the same supply. We really have a demand-supply problem. Largely, we don't have enough houses being built, and we have too many households being formed by immigration, population growth, people leaving home, that kind of stuff. Simple reality is you make 100 homes, you got 120 people who want one, you're in trouble. You have 100 homes being built, 80 people want one, and the prices are going to come down. Now, there are issues around building, the building industry, issues around economic growth and that kind of stuff, but it kind of comes down to that. When you're playing with just how much you can afford to add, it's like the bank's offering 40-year home loans and saying, well, the repayments are cheaper. It's like, yeah, but everyone's going to do that. So everyone's got cheaper repayments. And when you go to the bank, you say, well, bank manager, I can afford, here's my income. The bank manager says, oh, you can afford to buy $1 million house over 30 years. And you go to the bank the next day and says, well, if I make it a 40-year loan, you can afford to borrow $1.1 million. Now, I know that. Again, Adam does that. You do that, TC. Someone else watching does that. We can all bid 1.1, guess what the new house price is. So we've got to be a little bit careful of the second and third order impacts. They seem attractive for the first buyer. Fast forward, I think we end up with more people with more debt, paying more money for longer, and I'm not sure that's a great solution.
Alrighty, another question from Sharon. How many months or years away are we before net zero emissions damages our economy? It's probably politically worded, but I think it's a valid question. Is the pursuit of clean energy that is it something that is slowing the economy down? Is it damaging our progress?
Yeah, it is right now. I'm a fan of net zero, by the way, Sharon. So I'll put my green cards on the table. Not green party, just climate kind of. I like the idea of actually having a clean and sustainable climate. So for those that offends, I apologise, but I owe it to you to at least tell you straight. That being said, we are absolutely. So why is energy cost more right now? It costs more right now because our politicians, and again, I don't mean to make this political, but on both sides, the lack of consensus for 30 years, probably, has meant that why are we paying more? Because we're shutting down coal-fired power. Why? Because no one's going to spend any more money building new ones or refurbishing the old ones when they figure that in 3, 5, 7 years' time, someone's going to turn off the switch. So you're not going to build new coal-fired. You're not going to, frankly, not even spend any more money on keeping it alive. These companies want to close them down because they're not making any money. Governments are throwing them cash to keep them alive. Why? Because they didn't have that policy certainty. We don't have nuclear or renewable policy certainty because, again, same thing, whether you're a nuclear advocate or not, whether you're a renewable advocate or not, there was no policy certainty. No one's putting the money in and saying, I will invest the hundreds of millions or billions of dollars needed in 2007, 2014, 2021 to build these assets because I don't know I can get a return over the following 20 or 30 years, which you need because these are really long life assets. So that's the real challenge with, so what? Let's put it together. Why is net zero costing more right now? Because we don't have cheap baseload and we don't have enough renewables and we don't have nuclear. And so we're stuck literally in the middle of the perfect storm of policy inaction and politicization of energy over the last 30 years. Now, let's move forward. I suspect, I'm no energy expert, by the way, so let me go on a massive limb and then I'll come back. I suspect that if we could deliver, I don't know the numbers. If we could deliver cheap, reliable baseload with nuclear, and that could be done with a 80-year life, I suspect that in 15 years' time, we might start building nuclear for the next generation of power. The problem we've got right now is starting from here. What do? No one's going to build new coal without it being massively government subsidized. No one's building nuclear without massive government subsidies. No one's building renewables without subsidies, and yet we've got to have energy somehow. So there is no cheap baseload available for us right now at this moment. The lead times on nuclear, again, depends who you ask. It's super political, as Adam's already said. So I'm giving it to you honestly and straight. Don't at me, as the cool kids say. You can't get nuclear up and running probably within 15 years. Coal is dead by the end of that. So we've got a gap, right? And we've got a massive gap because of that policy. Should we have done nuclear 20 years ago? Maybe, but we can't. So now what do we do now? If you said, let's build nuclear, let's shut down coal, what's left? You gas in the meantime. I don't know. It's really hard. What I do think, and this is again my green card I will play, we have to count the externalities. So is net zero costing us money? Yes. Does pollution cost money? Absolutely. There's a cost to health? Yes, absolutely. We've got to find a way to bridge that gap somehow. Is it worth paying a little bit more to have a cleaner environment? Personally, I think so. You may disagree, and that's completely cool. That's what elections are fought over, right? So yeah, I get it. But yes, right now energy is more expensive than it should be because our polis didn't get their acts together. They rather play politics and bash each other and make it an issue for respective leaders and governments over 15 years. They made it a political tool rather than a genuine energy tool, and the national interest got put second, third, fourth, fifth behind political ambition, and that's why we are where we are.
Yeah, and look, I don't know. It seems like that sort of populist politics is increasing as we get older, or maybe we're just getting older and grumpier, Scott. I don't know which of those it is.
Probably.
Anyway, probably both. I'd say. Yeah, it's let's blame the internet. You're welcome. Question from James. He's asking about QBE Insurance Group. Right. What the outlook is. They've had a blinder of a year. They're up 20% in the year. They're up 5 years, 176%. Everything seems to be going right for QBE Insurance. What are your thoughts?
I would be. I don't know. I haven't known QBE really closely in ages. So I will absolutely say I don't know. I will say it was an early recommendation of Motley for Share Advisor. The share price now is the same as it was back in 2006. So, now that's not the company's fault necessarily, but it does tell you that these things tend to be up and down and maybe things go all over the place. What I would be worried about, so always think about cycles when it comes to businesses that are in cyclical industries. You've probably heard, I mentioned services inflation earlier. Inflation in insurance was through the roof, and these guys have made a lot of money. Now, that's okay if you're an insurance company shareholder. If I'm thinking about cyclical industries, where I'm most nervous about these companies is when they've had really great blowout years. Why? Because if they are genuinely cyclical, and insurance pricing tends to be cyclical, they call it hard and soft in the jargon. Basically, right now we've got massive pricing power for insurers. And maybe that continues forever, and maybe QBE is fine, and maybe they grow from here. In some other version of the future, that insurance pricing falls as competition takes over again, insurance inflation falls, and maybe profits start to fall from here. And if that is the case, and I'm not making any predictions, I don't know QBE well enough, I certainly don't have a view on your future of insurance pricing. But what I think you want to do is you want to buy these sort of businesses when they're in the doldrums, when everyone hates them, when no one's thinking about it, when price and profits are at cyclical lows. That's when you want to go hunting for this sort of stuff. When everybody's excited, when profits are through the roof, that's what I'm kind of thinking. Yeah, I don't know. If it's cyclical, I don't want to be caught buying at a multiple of maximum earnings. And that's probably my concern with insurance companies right now. Again, I'm not saying you should sell them all. I'm not saying you can't buy them. I have no view on QBE specifically. I just haven't done the work recently. But yeah, if you have a cyclical industry, it pays to be not contrarian for the sake of it. Don't always take the other view just because. But if you know things are high and low and high and low and high and low, and things are high right now, you should at least presume they're going to be lower at some future point. And whether they are or not, again, I don't know. But that's something to keep in mind when you think about the way they grow. I'm going to very, very quickly, Adam, spend about 2 seconds trying to look up some numbers very quickly on the fly. And I'll just pull up QBE's profits for the last little while. Here we go. Relatively quickly. They managed, so earnings have been, they lost 92 cents in 2020, made 75 cents the year after, $85, $1.33, $2.01. Now, that is either a business that is in hugely fantastic growth. They've more than, profits are up 150% over 3 years. Maybe that's sustainable because they're doing something different and new and exciting. If that's the case, that's fantastic. That to me, though, because I know it's cyclical or has been in the past, it's not a warning sign, but it is a sign for me to say, yeah, I don't know that I want to be assuming that profit will continue. Now, if the price is cheap enough, if the profit was to halve and it's still cheap, that's cool. I'd be cautious to the point of maybe a little bit skeptical of its ability to maintain those profits. And if so, just make sure you're paying a good price relative to the multiple lower profits, not just last year's.
All right. Well, from a business that you haven't looked at recently to one that you have, what are your current thoughts on John's Ling Group?
Oh, we think this is a really good opportunity, Adam, and I'm glad we've had this question. That is the other side of the cycle, right? There's literally the other side of the cycle. John's Ling, they basically do contract reconstruction or construction repairs for insurance companies. Now, think about what that looks like. There's a baseline of insurance. Houses burn down sometimes tragically, flood damage, storm damage, things happen, right? And that's kind of what they call business as usual. Just there's a cadence to these things. You insure enough places. Now, they're not the insurer, they're the builder, but for the insurance companies, you insure enough houses. A portion of those every year are going to have some sort of problem. And so John's Ling's job is to say to the insurers, we'll look after the reconstruction for you. We'll employ subcontractors. We'll make a margin on this. We'll take it off your hands. And they've done a really good job of doing that. That's business as usual. So this is not necessarily cyclical in terms of a nice wave pattern that we can track. But John's Ling's cyclicality or volatility comes from the mega catastrophes or catastrophes when it comes to claims. Think about cyclones, think about earthquakes, think about hailstorms, the really big, broad, expensive catastrophes that happen in the insurance market. When they happen, John's Ling is flooded with work. And so their profits skyrocket, frankly. They've got so much work. They're employing contractors. So they bring them on basically as they need them, and they make an absolute mozza. In the last year or two, that catastrophe business has fallen to about the lowest level it's had certainly in its listed history, in a decent number of years before that as well. So business as usual is fine. Catastrophe business has gone to zero. Now, on that basis, you say, well, what's happened? The market has said, we don't like this business anymore. Profits are down. Sales are down. This is a failing business or a declining business. I think, honestly, because people get to, when things are going up, everyone wants to jump on board, right? The happy consensus is always pushing up prices. When people go, well, I want growing businesses, I don't want this business, the price comes down because everyone's going to go, oh, it's boring, it's declining, maybe it's going to decline forever, let's get out of here. And you see that again, you see it with commodity companies, you see it with insurers, we've just talked about those on that sort of cycle. Again, not overly cyclical here, but the same kind of idea. Johns Ling has got almost no catastrophe business in the last year or two. If you believe that's going to happen forever, then the price is probably reasonable to maybe slightly expensive, very slightly expensive, if they never had another catastrophe job to do in their history. However, I unfortunately reckon, speaking of climate change and other things, I unfortunately reckon we're going to have more catastrophes. And when and if they turn up, Johns Ling profit will soar, and today's price will look really cheap. And so that's what you kind of have to eat. Now, you have to believe this is true and real and do your analysis by all means. We've made recommendations, but if you think, hey, over time, over the next 10 years, there are more catastrophes on an average year than there has been in the last couple of years, and yet the market is pricing the stock as if there's no more catastrophes ever, that's the opportunity. I mentioned variant perception. Our variant perception is we expect over the next, pick a long enough time period, 10 years, 5 years, 20 years, there will be more catastrophes on average per year than they have in the last couple of years. And if that's true, profit will be higher. And if that's true, today's price is cheap. And that's the thesis we have. I think Johns Ling is going to, look, could be volatile. It could take 2 years for the catastrophes to return, right? So no promises in the short term, as I said. We don't know anything about share price, let alone the weather in the short term. But longer term, I think it's cheap because I do think there will be more business for it to do in future than in the immediate past.
All right. Next question from Anthony, and it's about ARB Corporation. And look, if you follow Scott's Instagram, you'll know that his four-wheel drive rig is bristling with ARB gear.
Yes.
Is a big. I own shares in ARB as well. What are your expectations moving forward for the business?
Yeah, I own ARB shares and more in ARB gear. So look, good question. This is where I will talk about the short term, but only to make the point that doesn't matter, which sounds weird, but I will. The tariff trade has really hit some companies quite meaningfully. ARB makes some products externally to the US, Thailand, and Australia predominantly. Send them to the US, try and sell them. The US is a growth market for ARB if they can make it happen. So let's wind it back. ARB makes four-wheel drive accessories, parts, lots of good stuff. I can show you most of it. By the way, I was in the ARB shop only this week. So there's, I don't know if that's insider trading or not, but there's certainly a tip for you. I spent some money in ARB. So it's core business in Australia, as you would expect. The Australian business, and look, four-wheel driving is massive in Australia. We have, frankly, more places to go than most countries, so that kind of makes some sense. It's Australian-born business. One of their big growth opportunities is the US. So the market is expecting that US business to grow over time as they open more flagship stores, they sell more product, they use more distributors, they get in that kind of space in America. Now, if and when the Trump tariffs continue, that simply makes overseas produced products more expensive. If you're fabricating bull bars, roof racks, whatever in the US, you're going to have a price advantage over someone trying to sell them to you from Australia, from Thailand, from anywhere else. And we don't know what the final tariffs are going to be on some of these countries either, by the way. So maybe the Australian tariffs are different to the Thai tariffs are different to the whatever. So that's what's kind of concerning the market in the short term. In the long term, you've got a few things going for you. You've got a greater proportion of vehicles being sold that are four-wheel drives. You've got a greater proportion of those being sold, being fitted with some ARB products for different purposes. I said roof racks, bull bars, they sell antennas, they sell swags, they sell rooftop tents, all that kind of stuff. That's a great starting point for the base business. It's the best business, best name in the business, best brand. I love brands, as you probably know, Adam. Certainly our listeners, hopefully viewers, hopefully know. Sorry, great. Yeah, I love brand. It is the brand in forward, not the only one, but it's the key brand, right? It's the one that has the pricing power. It's the one that has name recognition, all that kind of good stuff. I suspect that'll continue to be a really good business. The US business is uncertain. I never love to pay up for international growth where they're not in those markets yet. Why? Because if it happens, it's great. But we've seen many, many, many businesses try and expand overseas and come back with their tail between their legs. Our banks have tried to do it in the US and Asia. We've seen just so many Australian companies try. Xero even, went to the UK, did really well. Went to the US, still struggling. Just didn't quite manage to get there quick enough and build a big enough business. Which is not to bag those guys, it's just to say overseas expansion is really, really hard. I like that they're trying it. They should try it. They should do their best to do it. I think they've got an even chance of maybe not better than even, but even chance of being successful. There's plenty of forward of accessory businesses in the States, right? So to believe we can just all of a sudden turn up and say, hey, we've got a thing you guys don't have, it's not going to happen. You've got to build that brand, develop it with quality, build it with the kind of fit for purpose goods that they do produce. So I think it's a high quality business, really shareholder friendly. We love insider ownership. We love that the family is still involved. The Brown family, ARB was Anthony something Brown from memory. This is the sort of business that we really, really like. So I own shares myself, as I said, plus I own plenty of their gear. It's a really good business, but I don't. In the short term, it may well be volatile because of that uncertainty about the US. In the longer term, they're either going to crack the US market or they're not. I don't suspect tariffs are the difference, frankly. It'll be whether they can build the brand, convince enough Americans it's the right product for them. That's going to be the story. If they do, shares will be probably pretty cheap right now. If they don't, shares aren't super cheap. They're probably fairish value. And that's when you're paying for that opportunity to kind of make that expansion. But I do think they're on a very, very good runway for growth, both internationally and here at home.
All right, that's a pretty good segue. We need to talk about the spectre of tariffs and delve into that a bit more. I think ARB is a really good example. A lot of Australian kind of homegrown Australian businesses, which are growth focused, cracking the US market is really the investing thesis that makes their business worth something to us as investors. Companies like Nanosonics, Guzman y Gomez. Yep. There's probably a stack of others. Does this?
Yep.
Yeah, another one. We could sit here naming them all day. Does this kind of make you sit back and look at your portfolios and your scorecard in Share Advisor and re-examine those specific businesses with the spectre of tariffs? Or, do we proceed as if maybe they'll remain around 10%? And it won't impact it too much. Like, what's your thinking as an analyst when you're looking at, not just the broader economy, which you've discussed, but for individual businesses?
Yeah, I love that question. I'm glad we're talking about stocks. We do tend to do a lot of macro. It's important, right? But I wrote an article today for our readers, basically saying, hey, for all of the noise, look for what actually matters to your investments. And my general approach is this: if a 10% tariff is going to be the make or break for your business, you probably haven't got a strong enough business in the first place. I don't mean, by the way, our viewers are thinking about, I'm criticizing maybe some of their companies, maybe I'm not intending to, but honestly, if that is kind of, and by the way, 10% is for the import price, not the final retail price. So if you're importing something, someone's adding their margin to it, maybe it pushes the price up 5%, 7%, 8%, something like that. There's not nothing. Anytime you move your price up and your competitors don't, you're going to lose sales. Now, not so go backwards, but they're going to take more market share from you than they have now by definition. Because anytime you have a cheap, there's very few businesses that can put their price up 10% and have no loss of sales. So there is always going to be that risk. But if it's the difference, I can think about what's great about being a long-term investor is we get to compound our returns. And compounding, Einstein almost certainly didn't say it was the eighth wonder of the world, though he gets credited with it. He should have, because it is. But the compounding reality of that is if you get a little bit of growth, and a little bit of growth, and a little bit of growth, a little bit of growth over long enough periods of time, you become a really impressive business. And so if the tariffs go up 10%, that sucks. That's terrible economic policy. It's bad for America. It's bad for world trade. It's bad for all of our standard of living. It's just dumb. But if you can't cop a 10% increase in your price once, now, of course, Trump could add to that after this, but probably won't. So let's say it's 10%. And let's say next year it doesn't go up, so it's still 10%. You've got a one-off cost impost. Almost like we talk about inflation plenty of times, right? Imagine a one-off cost of goods increase. And they say, okay, well, that's happened. Now, am I going to be able to sell more products to more people more frequently in future? If I can, then the tariffs aren't important. If I can't, the tariffs are really important, but more importantly, frankly, with or without the tariffs, you've got a business that's not growing and is potentially in all sorts of trouble, because if you're not growing, I don't necessarily say if you're not growing, you're dying, but if you're not growing, someone else probably is, and you're becoming less relevant over time. And so I think, I said, tariffs are a terrible idea. Take Nanosonics, take Audinate. These guys are best in class. Nanosonics does ultrasound probes, and Audinate does digital video and audio, what's the best? Networking. And these guys, by the way, Nanosonics is standard of care, a medical term that basically means it's the best in the business in most jurisdictions around the world. Audinate has something like a 90% market share in digital audio networking. These guys are absolutely rock star gold standard stuff. Now, if they can't cop a 10% increase in tariff and still do really, really well, then the business is much more fragile and brittle than I think. There is one exception, which is China. We know that Trump has 145% tariffs on Chinese products. Very few companies can cop a doubling of their price. So the question really is, how are our companies going to deal with those tariffs? Some will produce in the US. Apple's already said, not that we're talking about Apple particularly, but Apple's already said it's going to move all of its US supply to India, so they can basically avoid that tariff. So companies will find a way around it. And I really, really think for our viewers and our members, and just if you're thinking about the way your company operates, and you can't see it clearing its way through a annoying, stupid, but small tariff, then you probably need to reconsider how strong that business really is. There's some companies that, aluminium and steel, terrible businesses generally anyway, and a 25% tariff is a real killer because they don't have that sort of margin to play with. So, in some areas, I'm absolutely going to say, hey, if I own one of those companies, I'd be out. I really would. Not because I'm trying to short-term trade this thing, just because I don't know for sure and with enough confidence it can withstand that. Now, I will say I don't own any aluminium or steel companies already. Why? Because they're already rough businesses. They're low-margin businesses. They're price takers, not price makers. It's commoditized. It's normally oversupplied, or at least massively, really, really serious competition. So don't be in those companies anyway. But if you own a branded business, take Guzman y Gomez. I got to say it's going to have a tough time to crack the US market. Why? Because there's Chipotle and plenty of other. Tex-Mex is the west coast of the US, chockers with Tex-Mex options. Trying to take an Australian and Mexican to the US is a really tough ask. I'm not saying they won't do it. I'm just saying there's a saturated market, but they won't live or fail. They won't win or fail based on the tariffs. The ordinate will be fine. Those will be fine. Again, if they die, they're not going to die because of the tariffs. They're going to die because they've just not been able to secure that or maintain that market share they've already got. And so that's really where it's important to think about where is the value coming from. And a great business with a great market share, great share of mind, great brand, great technology, great leadership, great balance sheet. Let's roll off a whole lot of things there. If you've got those things, you can almost certainly scale the wall of a 10% tariff and get yourself across the line. The asterisk, as I said, commodity products, don't do it anyway. Chinese production is going to be tough, and that's one where I would be mindful of. And we haven't had to make any recommendation changes in my services, and because of that, most don't produce in China or don't produce sufficiently in China, or the US market isn't a massive market falling out of China. So a couple of different options there. But I think be mindful of it. Absolutely you're right to ask the question, mate. I'm glad people are thinking about it. Generally, for the most part, if your company's going to be impacted by it, you probably should know it in the first place. If it's a better company than that, you probably don't need to worry about the tariffs too much. There might be a short-term blip, up or down, or just flat, but that compound growth, if they're good enough, will continue for years after that anyway.
All righty. Moving on, a question about Drone Shield. Kiro says Drone Shield keeps popping up lately. I guess that's in more ways than one. The share price pops up by large amounts, yes, and therefore it pops up in the news. Is that business worth looking at?
That's a really good question. One of our analysts, Andrew Leggett, is a massive Drone Shield fan. I don't know that he's had to buy, but he certainly is keeping a really close eye on it. He's doing a lot of work in this area. At the moment, the challenge for us is, I mentioned being dominant in an industry, dominant in a space. Defense is one of the hardest industries to actually identify and analyze, because most companies are required to not disclose their customers, not disclose most of the financials, not disclose most of the technology. Why? Because it's national security, right? It matters. And so it's really hard to know. So one of the problems so Drone Shield provides anti-drone technology. Effectively, what can be done with drones these days? There were some apparently similar companies, not Drone Shield, but around the funeral for the Pope, right? And the idea basically is drones can now carry explosives. They can carry bad stuff. They can get in the way of aircraft. You need to neutralize them and deal with them, whether it's shooting them down, blocking their transmission infrastructure and frequencies. Lots of different ways this can be done. And so it's going to be a burgeoning industry. I think the reality of drones are here to stay. Anti-drone measures are going to be here to stay. They are required. They are necessary. Speaking of social media, mate, I saw one of you flying over the Gold Coast recently, which is pretty bloody impressive. So just maybe tell our viewers more about that. That's different to drones, of course. The opportunity for Drone Shield is huge, absolutely massive. What's hard about Drone Shield is to know really how big that market will be, how dominant they are in that market, and when they're at the forefront of technology. Here's the real technology is wonderful. The hard part with particularly business to business technology, or in this case, business to government technology mostly, although some private airports are also talking to them, is who is developing the next generation of anti-drone technology. And a really bad analogy, but the kind of close one I can get to is MySpace and social networking was wonderful until Facebook just kind of went bang. And you kind of go, well, MySpace had the right idea. The social network was going to be a thing. This didn't get big enough, fast enough, someone beat them to it. Speaking of technology, think about LPs, cassettes, CDs, Laserdisc, eventually, HD, and then just straight out streaming in 4K. At what point does I'll invest in cassettes, or I'll invest in CDs, or I'll invest in DVDs? The new technology can simply overrun the previous one. So the hardest part with Drone Shield is having a view about whether they're going to remain at the forefront of this technology, or we talk about it as, I remember that when they were good before this other thing turned up, before such company developed their new technology that blew Drone Shield out of the water. So it's incredibly, incredibly difficult to know. I would encourage people not to get caught in the story. And this is one of those things where drones are big, defense is big. Wow, drones, anti-drones, defense. This could be a big thing, therefore I'll buy the company. Again, not an unreasonable theme. Just because you've identified a theme doesn't mean the company itself will necessarily make a fortune. Now, I've used the example a million times before. Air travel has absolutely skyrocketed over the last 50 years, right? And 50 years ago, if you told me how many people would be flying how many kilometers a year, I'd say, well, I'll sell all my shares, I'll sell my house, I'll sell my son, and I'll buy shares in airlines because look how big they're going to be. Turns out the value didn't accrue to the airlines, it accrued to the airports and to the consumer. So just be careful getting caught up in themes, thematic stuff. AI, probably the same, frankly, right now. Will AI be big? Absolutely. Do we know who's going to win from it? I'm not entirely sure. Maybe we do, maybe we don't. I'm not saying don't invest in any of them, by the way. I'm just saying look at the companies themselves. Don't just get caught up with the technology. Say, well, the technology is a thing, therefore I'm buying one or all of these companies. It's unlikely that's going to be a winning play. Trying to find the winner. David Gardner, I mentioned before, he looks for the first mover and top dog in emerging important industries. So who's the first mover? Who's the top dog? Do they have a sustainable competitive advantage? Those are the sorts of things you want to look for when it comes to particularly business to business or business to government tech, where it's hard for any individual to kind of objectively say, oh, yes, Drone Shield is going to win because of this. It's just not easy enough to do as an individual, even as a professional. Really, really hard because you simply don't know who else is working on what in a garage or a workshop somewhere that may be the next generation technology.
Yeah, or indeed the front lines in Ukraine as well, where a lot of
yes, of course.
Drone defense activity is taking place and it's being done on the run. All right, one final question from Rodney, and this is a good one to finish off with. A bit of a philosophy, investing philosophy. I'm sure I've heard you say in your early years you should look for high growth stocks. Then when you're in your later years, we should be looking for high yield stocks. Why is that?
I don't think I've said that, Rodney. I hope I haven't said that because it depends is the answer. I'll tell you why people do say that, and I'll tell you what my thoughts are on that. And you're right, Adam. Love the question. Thanks, Rodney. It's a great way to finish off. When you're young, when you're building a portfolio, your job is to build the nest egg to a point. Now, you can do that either way. You can do it with a company that's growing really quickly and doesn't pay a dividend, or you can do it with a company that's paying a really nice dividend, just reinvest that dividend over and over and over and over again, and do really, really nice. We mentioned Dominos. Dominos, I don't know if it's still true now, but was paying a dividend that was higher than its share price like 10 years ago, whatever the numbers go roughly. I'm butchering the analogy. But my point is, dividends can be enough to add to your return. In fact, you shouldn't care what the return comes from. You want to maximize your total return. If I get 2% from capital growth and 8% from dividends, or 8% from growth and 2% from dividends, or 10% from either or nothing from the other one, I'm getting a 10% return. There's some tax implications, but we'll leave those for another day. Doesn't matter, shouldn't matter to you, or shouldn't matter to me where the return comes from, as long as I maximize that return. Whether I'm young, whether I'm old, who cares? If you believe that growth companies are going to outperform dividend companies, then of course you want to buy growth until you want the dividends. So what I think you're referring to is people who will say, it may have been one, I don't think it was me, I don't think I've ever said that, maybe one of the team, maybe it's someone else. And that's okay, people have different views. If you could grow faster with growth stocks than dividend stocks, yeah, you want to maximize your return. Of course you do. Why would you then switch to yield stocks? Well, some people will say, when I'm at a retirement age of some description, I don't want to have to worry about fluctuating share prices to buy and sell and try and sell down some shares to fund my living expenses. I want to kind of peel off the income. I'll take the dividends and use that to fund my living expenses and leave my portfolio alone. In fact, we have a service called Motley Everlasting Income. It's not an ad, but that's exactly what we do. We take a nest egg portfolio and we turn it into an income stream for our members. So that's where yield can be really useful in retirement. Plus, you get some nice franking credits if your companies are paying fully franked dividends. So that's why some people might think that. My personal view, a couple of things. Firstly, as I've already said, maximize your total return at any age, just because why would you not? So if you've got some great dividend payers at 25, knock yourself out. We've got some members of Motley Platinum. I keep mentioning it, but we had a in-person member event a few years ago. And a decent portion of those people, they won't mind me saying, many of whom are retired, are like, I still want to get growth. I want to maximize my returns. That's what I'm here for. So I don't think you should do it by life stage particularly, with a couple of exceptions. If you need the income and you need the stability of the income, dividend income is going to be more stable, not perfectly stable, but more stable than capital income. Why? Because the market goes down sometimes. About 1 year in 3 on average, it goes down. Sucks, but it happens. You don't want to be selling shares. Imagine during COVID. Imagine in March 2020, if you said, I'm going to take some money out and buy a boat in March 2020. All of a sudden, your shares fall 38%. Now, you probably put off the boat purchase, but if you needed to replace the car, if you needed to sell some stuff to pay an energy bill, you're kind of selling out at a really cheap price. So dividends can be really, really useful during that period if you can do that. For people in retirement, though, here's the way I take this, Rodney. Accumulation, don't care. Maximize your total return no matter how you get it. In retirement, or when you're getting close to retirement, here's the other thing, by the way. People say at 60, I've only got 5 years left. I need to be more conservative. If you get to 60, you're probably going to get to 90. Now, I'm not saying therefore be radical or be aggressive or don't be conservative. What I am saying is most people shouldn't see retirement as the end of their investment journey. Now, if you're going to cash out your super and pay off your house, buy a boat, and you're never going to have investments after that, well, yeah, you need to care. Any money you need in the next 3 to 5 years shouldn't be in shares in the first place. So that's always true. But if you get to 60, I've got 5 years to retirement, but I'm going to be retired for 25 years after that, you've got almost as much time as a 25-year-old does before they actually retire. Not quite, but not far off that. So I really would encourage people, if you're in those later years of working life, early years of retirement even, presume you've got 2 decades left and then invest accordingly. As I said, if you need the capital, be more conservative with it because you don't want to have to sell at a low price. But if you don't need the capital, if you can afford to live off the income and get some capital growth, that combination is what I'd be going for, particularly in the later years of work and even the early years of retirement, because you have the opportunity. And don't be aggressive, don't be silly, don't buy specky gold miners and try and make your fortune. But if you've got a great quality growth company, what's a great example? You mentioned Ordinate before, Adam. If you think that's going to be a great 20-year investment, then go. Don't sell that and buy a high yielding, slow growing bank or something because you feel like you're being more conservative or reasonable or whatever. It's horses for courses. Capital. If you need the capital, preserve it. If you need the income from dividends and you can't afford the fluctuations, go for it. Otherwise, maximize your total return after tax. Yes, include the franking credits. But yeah, don't be too constrained. There's a lot of. I'll finish this up, Adam. Sorry. There's a lot of common accepted wisdom, right? Which, frankly, I think is kind of largely nonsense. It's kind of it's safe. Someone says, "Oh, you should do that because you'll feel better about it." And if you feel better about it, do it. But blue chips are safe. Terrible advice. They're not. HIH was a blue chip. AMP was a blue chip. So please be careful of accepted wisdom or so-called common sense. Do the stuff that fundamentally makes sense because it makes sense, not just because everyone says it. And for me, I would go growth. I'd go growth stocks through most of your life. Add income by all means. Move towards your income more at some point if it makes sense. But don't change just because you hit an age or because you're changing life stage. Think about your circumstances, think about what you need from your investments and tailor it that way, not just because you're at an arbitrary age.
All right, very well said, Scott. That's all we've got time for. So thanks for joining us, and we'll see you next time.
Cool on.